Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Go, folks. It's been busy here this morning. That gives you all the economic data that's released by the government. A lot of stuff here. JOLTS, factory orders, durable goods. I mean, I heard about all this stuff in economics class. I didn't really know what it is, but I see the numbers here. Michael McKee, he knows what's going on. He does all the economic stuff for Bloomberg Television, radio, and everything else, actually. Michael, what of all the economic data here, what jumped out at you today? What do you think the Fed is going to focus on maybe today?
Well, the Fed's going to look at JOLTS because it does show the labor market is in a looser state. We're pretty much back to where we were pre-pandemic in terms of the number of job openings. It was a drop, a bigger drop than expected from last month, but the prior month, June, was revised lower as well. And when you look at what we've seen in the time series, we've seen job openings in the 7 million range for 3 of the last 4 months. So this is not a shock. It's not a major change in the overall outlook. These numbers are not necessarily super reliable. The quits rate, which people take as an evidence of how people feel about the labor market and whether they can continue to get jobs, still at 2.1%, where it's been for a long time. So it doesn't look like it's making major news today. Oddly enough, factory orders come in up 5%. Now, durable goods were up as part of that, a revised 9.8% from 9.9%. We knew that. So what that's telling you with a 5% gain after a negative 3.3% the month before is non-durable goods sales were pretty good. And that is good news for the idea that the Fed doesn't have to immediately cut rates or anything like that. Probably the most interesting number of the day, though, trade balance. The trade balance at $78.8 billion,
I wouldn't have guessed that.
The widest in 2 years, up from 73.0, and just a little bit lower than the forecast, but basically saying that we are importing a lot of stuff. Now, there could be 2 reasons for that. One, the economy is still in good shape and people want to buy, or 2, retailers are stocking up for the holiday season, which then becomes a question for your retail analysts of, are they making a bad bet or not? Is the economy going to slow? Are consumers going to stop spending and we're going to be stuck with a lot of inventory?
All right,
so
put that
that's
all
why
in
it's an interesting number.
Put that in your hat, shake it up. What's the trajectory for the U.S. economy based on what you've seen so far?
It looks like the trajectory is pretty much the same as it was, that the economy has slowed. We're not seeing it fall off a cliff, and therefore the Fed is going to say we can cut rates, but we don't have to do an emergency rate cut of 50 basis points or anything like that. We can do 25.
All right, Michael McKee, thank you so much for joining us. Really appreciate getting your expertise there on a bunch of economic data crossing the tape here this morning.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Yesterday, Nvidia suffered a record $279 billion rout as AI worries sink stocks. They also got a DOJ antitrust probe. A lot of headwinds for that stock, a lot of issues for investors to figure out for Nvidia. Stock still up over 100% year to date. Mandeep Singh, he's the guy we talked about Nvidia all the time. He's Bloomberg Intelligence. He's pretty smart. But the guy we really want to talk to today is Justin Teresi, Antitrust, Litigation, and Policy Analyst for Bloomberg Intelligence. I've never met you before.
Likewise, obviously.
I didn't hire you, so I'm just going to go on Mandeep's recommendation. What's the DOJ saying here as it relates to Nvidia, and how concerned should Nvidia and its shareholders be?
Yeah, so I think the real takeaway here, the most important thing to keep in mind is the timing that's associated with this. So news broke a couple months ago that DOJ was looking into Nvidia here. And what we think, there are a couple issues they might be interested in. One, market consolidation. Maybe Nvidia is growing a little bit faster than the authorities would like to see. The other issue they might be interested in is one related to how they're selling their products. Are they tying things into anti-competitive manner? Are they bundling products in such a way that it's really impossible for other folks to compete? But really, this development yesterday, in terms of the subpoena, really is something we were expecting. And that's because what it lays a formality upon this investigation that wasn't there before. Previously, it was an informal questionnaire. Now, Nvidia is really going to have to certify that the information it's handing over to DOJ is what they're looking for and a true and accurate depiction of what they want to know about.
Is there a political element to this? I mean, everybody's got Nvidia in their 401k. Does the Harris campaign pick up the phone and say, couldn't you have waited till after November?
I think that might be the question of the day with relation to this. So look, if I'm Nvidia's attorneys right now, what I'm trying to do is to delay responding to this as much as I possibly can, right? Because there is that element of an election coming up in November here. What does a new administration do with the investigation itself? How hard do they go? Are they more open to a settlement than the current regime might be? So that's really the name of the game here. I think you're spot on there that the tea leaves
and the
of
question
the election,
for Vice President Harris, for me, is: are you going to continue this aggressive antitrust behavior in a new administration potentially?
Right. So
it becomes a real campaign issue, doesn't it?
It does, and I think it has. Right. I think we've seen that already with a lot of rhetoric coming from both the Harris camp and Trump camp, J.D. Vance on the issue too. Right. So I think moving ahead, we think there could be some softening perhaps in some ways, or a more measured or deliberate approach to things if Harris were to win the White House. But what we see from the Trump camp is J.D. Vance does have that rather strong anti-big tech mentality whenever we talk about antitrust with him as a candidate. So really, we're not quite sure what to make of the situation there, but delay is the name of the game if I'm Nvidia right now.
Mandeep, when you talk to investors or when you hear from the company, what do investors think about this risk? Is it just another big tech company facing some regulatory headwinds like we've seen for years?
Yeah, I think Nvidia now is part of that club that Amazon, Google, and Meta, which have faced regulatory scrutiny over the years. And look, in the case of Google, it was fairly obvious that regulators doubled down on their distribution agreements that they had with Apple and Samsung to be the default search. So in this case, it would be interesting to see DOJ's approach. What is it that they really want to focus on in terms of how Nvidia is distributing their chips to the hyperscalers and their largest customers? Because clearly Nvidia has a lot of interest from all types of customers. The market is undersupplied. So do they have an algorithm to say, okay, I'm going to distribute X number of chips to customer A and Y to customer B? And look, it comes down to Nvidia's how they have their relationship with their customers, and they can distribute the chips they want.
I know it seems like it's a market operating efficiently, but what do I know? But what I do know is the beauty of Bloomberg Intelligence is we bring together industry and company-specific research analysis, and Mandeep Singh, he's been doing it for years, and Justin Teresi, antitrust litigation policy analyst at Bloomberg Intelligence. We can bring these folks together. They can partner their research, integrate their research, and give you a really good view of what it means for some of these companies as they face some of this risk from the regulators. And again, it's great to have that. It's part of Bloomberg Intelligence. BI Go on the terminal. Oh, and guess what? It's
Nvidia shares seem to have bottomed out today.
Exactly. All right, Mandeep Singh, senior tech analyst, Justin Teresi, antitrust analyst, Bloomberg Intelligence, in our studio, breaking it down for Nvidia.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go to our next guest, Paul Karger. He's co-founder and managing partner of TwinFocus, joining us from Boston, Massachusetts via Zoom. Paul, what are you telling your clients these days as to where the best opportunities are? We've got the S&P 500, up 18%. I mean, that's pretty darn solid, but yet I can still get a decent yield in a 2-year treasury at 3.8%. What are you telling your clients these days?
Paul, John, thanks for having me. Here at TwinFocus, we've largely been invested according to our policy benchmarks all year. The expectation has really been for a soft landing, reasonable growth, low inflation, lower rates. before today, before the JOLTS number that just came out, the Fed funds were pricing in a 100% probability of a 25 basis point rate cut in September, November, and December. With this most recent number, a bigger miss than expected, and it seems to be signaling, greater job availability out there and kind of a weaker job market. You've seen that Fed funds market respond with, perhaps a greater chance of perhaps 50 basis points cut at this next meeting. Given all of this, as mentioned, we've been focused on remaining fully invested, and we have been able to take advantage of the run in risk assets, but we're looking to diversify our risk more broadly and, away from this, purely the AI trade, if you will.
All right, Paul, I think this is one of those moments where I'm supposed to throw confetti in the air.
Sure.
The yield curve.
Yes.
Disinverted.
Oh, wow.
So 2s and 10s now, back. I spoke too soon, but anyway. Do you attach, Paul, they used to tell me that inverted yield curve precedes recession. Well, didn't happen. Do you put, what's your significance of this, do you think? Do you pay attention to the yield curve?
We absolutely are focused on the yield curve. There's perhaps a number of reasons why we didn't see a recession. In part being this whole AI trade. The productivity that we've seen in the economy and the forecasted productivity that we will see from AI. That combined with a lot of the stimulus that was still waning and in effect after COVID. That said, recession, I think, at some point is not completely off the table. Hopefully we're able to escape with just a soft landing. But we're 18, 19 years into the business cycle here. So it wouldn't be surprising to see something at some point. There is this talk of rate cuts become obviously more prominent with some weakness in inflation. But I think that, it usually takes some time to see those rate cuts impact the economy. So we may not see that until Q1, Q2 next year. Until then, the market's going to try to decide on the overall direction. And I think we're just going to continue to see a lot of volatility between now and then.
Paul, in terms of maybe trying to temper some of that volatility, what do you guys, or how are you guys approaching the fixed income markets? Are you, I'm content to sitting in a 2-year treasury at 3.8%, but some people might want to take some more credit risk. How do you think about fixed income opportunities today?
Sure. So let's talk about credit and kind of safe treasury allocations. We've largely been barbelled with perhaps a bit of an overweight towards the shorter end of the curve. So when rates were up 4s and 5, we were taking advantage of locking in some 10-year money then. While it's compelling to sit in a 3.5%, 4% short-term treasury, you do have some reinvestment risk if you see, rates come down. So we have been starting to nibble at some duration. On the credit side, we've been less enamored with this whole private credit trade that everybody seems to have fallen in love with. And so we've been focused on really more idiosyncratic return streams or areas of the market that seem to be more capacity constrained. And they're harder to find today, for sure, as there's a lot of money out there chasing various trades.
So you see a softening in private equity. I think in your investment note, you quote the great Roberto Duran. No mas.
No mas. Yeah, we've like many institutional family office investors over the past decade, 2 decades, we've allocated significantly to private equity. Which has served us fine. But we think going forward, the market has completely changed. And there's just an enormous amount of market participants. There's just an enormous amount of capital chasing. And we found more compelling returns, frankly, in public markets, which, I would have never thought I'd say that 5 years ago. But that's where we are today.
Hey, Paul, thanks so much for joining us. Really appreciate getting a few minutes of your time. Paul Karger, he's co-founder and managing partner at TwinFocus up there in Boston.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's take a look at Nordstrom. The Nordstrom family bids to take the chain private for $3.8 billion. Stock pretty much unched on the day, so not a big deal here for most shareholders. Stock is up 23% year to date. It's got a market cap of about $3.7 billion. You throw in the net debt, it's a little over $7 billion total enterprise value. Let's check in with Mary Ross Gilbert. She's Bloomberg Intelligence Senior Equity Analyst covering the retail space. Mary Ross, thanks so much for joining us here. What do you make of what the Nordstrom family members are suggesting here? I know this has been in the news for a while, but where do we go from here?
Yeah, so the Nordstrom family has been wanting to take the company private for some time, right? We've seen this iteration before, but this time partnering with the Mexican retailer El Puerto de Liverpool, they're in a good position in terms of coming up with the financing because they're going to pony up about $1.2 billion in cash in addition to rolling over their about 10% stake in the stock. And of course, the Nordstrom family combined, they own about, a third of the shares. So you've got 43% wrapped up. They do need 2/3 approvals. We just need to get another 23 to 24% on board. And you look at the price, there's really no premium here. And they're basically saying, well, if you look at the time that we proposed this transaction, which was back in March, the stock was trading much lower, somewhere around, 17. So this is really a premium to where the shares were then, and it's about a 35% premium. But if you look at how the stock has traded over the last 5 years, it's pretty much close to the average price. And over the last 10 years, it's at a steep discount, like 41% discount, over the last 10 years. So, yeah, there's not a premium. Could another buyer step in here? It's possible, but trying to piece together a transaction could prove onerous. And it's going to, involve debt, as we know, but not as much incremental debt. The company already has about $2.6 billion, so they'll probably have to bring on another $1.8 billion to be able to complete this transaction. Right. And of course, the transaction is contingent upon that deal getting done. But with Nordstrom, what really stands out versus the other department stores, and of course we know that the Macy's proposed buyout has gone by the wayside at this point. With Nordstrom, you've got a fast-growing off-price segment, and that's what's really exciting here. And their comp sales were up over 4%. Their total growth was up 9% in the second quarter. And if you look at their full-line stores, the sort of traditional department store, they were up almost 1% on a comp basis. But if you look at their peers, they were all down, anywhere from down 3% for go-forward stores for Macy's to down 5% for Dillard's and Kohl's. So Nordstrom sure looks like they're in a better position. They're also much smaller, only 93 stores versus close to 500 department stores over at Macy's, which of course that's why they're closing 150.
Let me just ask you, when you're a company and you have problems and you turn to deal making to try and solve those problems, what does that say? You've got about a minute left.
Yeah, so in this case here, I think they're employing a number of new strategies, let's say with the full line store and with off price. I think they're off to a good track there, and big expansion. They're going to be opening like 22 rack stores this year, and I think they're going to continue that pace going forward. So I think that the idea that they don't have to be under the quarterly lens of investors is probably a relief for them.
Right. All right, Mary Ross, thanks so much for joining us. Mary Ross Gilbert, Senior Equity Analyst covering the retail space for Bloomberg Intelligence. She's based out there in Los Angeles. Nordstrom, some of the family members offering $23 per share in cash to take the retailer private for $3.8 billion.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We need some perspective on this markets after yesterday's sell-off. Got a little bit of green on this screen here. People are trying to get a sense of how do you factor in what was a decent earnings cycle for most of the S&P 500, plus with a Federal Reserve that is likely to begin cutting rates. How does that factor into the outlook here for risk assets? Margie Patel, she's got a lot of perspective, a lot of experience. She's a senior portfolio manager at Allspring Global Investments, joining us from Zoom from Boston. And again, if you're in Boston, Our new home is 92.9 FM in Boston. Margie, thanks so much for joining us here. How do you piece this all together here? We're pretty much through the earnings season. Investor conferences are kicking in high gear here in September. September 18th, the Fed is going to meet and presumably start lowering rates. So how do you put all that together, and what comes out for you?
Well, I think right now we're in a period of cross currents because the overall earnings reports for the quarter were once again pretty good. However, we did have some slight weakness from expectations for some of the large tech companies, in contrast to the previous quarters where they surprised on the upside. And since this group was so heavily overowned, frankly, it was really due for correction. And we've seen that over the last, really since the end of July into yesterday, where you just had this cascade of all the techs going down and other economically sensitive sectors that have done really well. So I think it's just really adjusting, waffling around, waiting for the Fed to once again come in and be on the late side, frankly. And I think now that we have a news gap, so this is a seasonal slow period of the year. And I think that by the end of the year, we should have a strong December and a strong rebound after the election, really no matter who wins, because that's just really what happens in election years. So a little more waffling around, and then I think maybe in December, we'll see the market move up.
I got to get this one out of the way. Put your Bond hat on for a second. Did you throw confetti in the air when the curve disinverted between 2s and 10s this morning?
Well, it's really amazing how the curve has come down, and we're just about flat now, which I think is a step. And really, to me, it says the market is making the adjustment to interest rates that the Fed really should be doing. In other words, pushing down short rates compared to long rates. So to see the 2-year come down so much over the course of this year compared to the 10-year and have both of them really well under 380 is pretty encouraging. It says that we are in the middle of a period of very, very tight money, and all we need is the Fed to come in and provide some stability. I think the Fed is really the one who's behind the curve. The market's really doing what the Fed should be doing by bringing rates down and putting a little bit of a floor under how big of a correction we'll have.
So, Margie, are you a proponent of kind of moving away or de-emphasizing or diversifying away from some of the big tech names into this diversification trade, if you will, the rotation into maybe some smaller caps, maybe some lower valued sectors? Is that something that interests you?
I'm a little lukewarm about that, because you did have some of those sectors like small caps have a big jump up in price just because they had really gotten so out of whack compared to the rest of the market. But if you think we're in a period over the rest of the year of, frankly, slow economic growth, maybe a GDP of 1%, 1.5%, something like that, it's really hard to see how some of those more value companies that have slow growth markets are really going to continue to shine. So I think you really have to get through this volatility period and then look for companies that should have higher than average growth, higher than a GDP backdrop of, say, only 1.5%. So I think it's a short-term move. The long-term, I still think, will be with the larger companies that have a sustained growth path for cyclical growth.
Nvidia 108.40-ish, is that an entry point for investors? Your thoughts just on the tech space specific to Nvidia?
Well, certainly you've had a huge correction there. And if you thought it was rather highly priced at 140, very high PE, certainly with about a 30% or more adjustment in price, it looks much more fairly priced compared to its growth. So I would say that it's certainly a better buy here than a sell at these levels.
Fixed income, I see the best performance is in high yield. Is that something of interest to you, or is it spreads too tight?
Well, spreads are tight. Double Bs are a little over 2 basis points more than treasuries. Single Bs maybe a little over 3 percentage points, which is narrow historically. However, defaults are very low. Defaults are under 4%. And if you look where we are in the credit cycle, the Fed is now, hopefully one of these days, going to be on an easing cycle where short rates come down. So that says to me that's a pretty good backdrop for high yield. The big negative is, of course, the yields aren't very high. You're looking at, say, 6 to 7.5% for most issues. But really, if you think the economy is going to be growing very slowly, which I do, 1.5%-ish say, then that implies that the growth in the equity market over the balance of the year may well be low to mid-single digit total return from here, which would really be about comparable with what you get from high yield bonds. So we may actually have high yield bonds running neck and neck with equities over the next few months. So I think they're pretty good, especially if you are more looking for income rather than capital appreciation.
All right, Margie, thank you so much for joining us. Always appreciate getting your thoughts and perspective. Margie Patel, Senior Portfolio Manager, Allspring Global Investments, joining us from Boston on Zoom.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Interesting story across the Bloomberg terminal here, John Tucker. The Biden-Harris administration's big bet on Intel Corp to lead a U.S. chipmaking renaissance is in grave trouble as a result of the company's mounting financial struggles, creating a potentially damaging setback for the country's most ambitious industrial policy in decades. I kind of forgot that 5 months ago, President Biden traveled to Arizona to unveil a potential
That was a big deal. A news conference package. Standing there with Mr. Gelsinger.
Yeah, $20 billion, and that is now in jeopardy, perhaps. Mackenzie Hawkins joins us, Bloomberg News Technology Reporter. She joins us. Mackenzie, you reported on this story here. Give us the latest here on Intel and the ability of it to kind of fulfill its end of the agreement with the U.S. government.
So 30,000 foot perspective here, the U.S. government has this $39 billion program to issue grants to chip companies and convince them to do manufacturing on American soil. And Intel is supposed to be the biggest winner from that effort. The package that you referenced that Biden went to Arizona to announce was $8.5 billion in grants and $11 billion in loans, putting aside the 25% tax credits that Intel could maybe get on what could be $100 billion in U.S. investment. So we're talking about massive, massive sums of money here. But all of those agreements are preliminary. And right now, the company is undergoing due diligence and hashing out the finer details of its accord with the Biden administration. That happens to be going on at the same time as Intel is in dire financial straits. The company had a pretty disastrous earnings report last month, sent its shares tanking, the worst rout that it's seen in decades. And now there are a lot of questions looming about whether Intel can actually pull off this big U.S. manufacturing expansion. And given its centrality to what's called the CHIPS Act overall, whether the Biden administration will still be able to achieve its policy goals.
Now, I'm no politician, but if I'm going to head out to Arizona, have a news conference as President of the United States, I would think that somebody on my staff has actually done the due diligence to make sure that Intel, who I'm having a news conference with, is actually going to be able to meet those milestones. Am I too cynical?
Well, the Commerce Department, which is running the CHIPS Act, has actually set up this pretty intentional process from the outset, telling companies, you apply for this money, we reach a preliminary memorandum of terms. That's what was announced for Intel and all of the companies that are part of the program, which include some of the world's leading chip makers, Taiwan's TSMC and South Korea's Samsung. And basically the government is agreeing to underwrite this program. But companies have to go through due diligence in a sort of private equity type model after reaching that preliminary agreement. Then they sign a final term sheet. And then they have to actually hit the milestones on their projects before they receive any money. And the government has the ability to claw back money if they hand it out, but the projects are never fully completed. So there are a lot of guardrails built in place to prevent the Biden administration or the next administration from actually handing out money to a company that may not be able to pull things off, if that ends up being the case with Intel.
Intel's not even sharing all the information, is it?
Well, they're going through a pretty contentious due diligence process right now. The company and the Biden administration say that they're working hard to reach a final agreement, but there are certain requests that government officials have made of Intel that the chipmaker doesn't want to deliver on. And I think the challenge for the administration is such a big part of vetting a project's commercial viability is knowing that they have customers, that there will actually be demand for the chips that they intend to manufacture. And in Intel's case, the picture is a little bit bleak. The company has secured some potential commitments from firms including Broadcom, MediaTek, and Microsoft, but none of those have chosen to go to full production with Intel's facilities yet. Commerce Secretary Gina Raimondo encouraged leading AI chip makers Nvidia and AMD to consider manufacturing at Intel's Ohio facility, which Pat Gelsinger said could be the world's largest chip making factory if it's fully built out, and neither of them plans to do so. Oh, wow. So this is putting the Biden administration in a bit of a difficult spot, and despite the fact that they haven't actually released any money yet, it could become potentially a huge political liability.
What is the administration saying in terms of any backup plan?
So we have to keep in mind that Intel is just one company that is supposed to benefit from the CHIPS Act. There were hundreds of companies that expressed interest in this money, and the Biden administration has announced investments in the preliminary agreement form of north of $30 billion to around 16 or 17 firms in total. And that includes commitments from all of the world's top chip makers. Intel is one of them, but as I mentioned before, TSMC and Samsung are also planning on producing leading-edge logic chips in the United States. Micron, one of the world's top memory chip makers, is building factories in Idaho and New York. So there are lots of companies that are part of this program. At the same time, Intel is uniquely important. The U.S. wants to reach the U.S. wants to reach 20% market share, a fifth of the world's most advanced logic chips by the end of the decade. Intel's factories are a crucial part of that effort, and the company is also supposed to be the sole intended beneficiary of this $3.5 billion program to make secure semiconductors for the Pentagon. So there's a backup plan insofar as there are other companies involved, but Intel matters a lot.
And presumably this is to create jobs, and it comes at a time when Intel's cutting around 15,000 jobs.
Exactly
so
right.
There you go.
Mackenzie, great reporting. Thank you so much for joining us. Mackenzie Hawkins, technology reporter for Bloomberg News, joining us from Washington, D.C. Appreciate that. So Intel, again, another day, another piece of bad news here. And it just seems like, and again, I don't follow the chip business day to day, but it just seems like the technology to some degree has passed by Intel, and they missed kind of the AI wave or evolution, whereas Nvidia, boy, right
Which
there.
Nvidia doesn't make chips, they just design them.
Exactly
Okay.
right, exactly. That's my understanding.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.